You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Guys, it is my honor to introduce my guest for today's show, co-founder and partner at Worcester Investments, Jesse Worcester. Jesse, how you doing today, my friend?
Doing great. Great to be here.
Yeah, thanks for joining us here. And you've got a lot going on, lots of irons in the fire. So I'm super excited to jump into your background, your story. You guys have a lot of excitement happening there in the Kansas City marketplace. And so really looking forward to diving into the meat and potatoes of your firm and how you guys have built to essentially be a completely vertically integrated multifamily investment company. And not just multifamily now. It sounds like you've actually been sticking your toe in the water and a few other asset types as well. However, before we go down that road, I'd love it if you could, Jesse, take a few minutes for the folks that aren't familiar with you or your firm. Tell us a little bit more about yourself and Worcester Investments.
Sure. Well, we are a family-ran company, and our story really begins with our father, who was a lifelong pastor. So we are pastors' kids, and it's myself and my two brothers who started this company and run it today. And our father, we grew up in Eugene, Oregon. So even though we're in Kansas City now, we're West Coast kids. And we grew up playing sports together. So it was, we're pretty close in age. We were on the same teams. And so we learned to be teammates and to work together. And we learned that we work well together and that we get along really well. And we have a lot of complementary skill sets. So by the time we got out of school, it was pretty clear that we wanted to go into business together. And we had read some great books, Rich Dad, Poor Dad, Intelligent Investor by Benjamin Graham, both of which we think are phenomenal books even to this day, and determined that we wanted to go into multifamily real estate. We knew that, it being the second most basic human need, we felt, okay, we could go out and we could do, an office building, but the needs of having an office can sway with the economy, but regardless of the economy, people always need a place to live, a roof over their head. So we felt really good about that as an industry. And our father took out, he was a pastor of a very small church. So we grew up lower middle class, never had a whole lot, but he took out a second mortgage. And of course, this is 05, 06, when you could pretty much get access to funds,
Sure.
Regardless of what piece of real estate you own. So he took out a second mortgage, $200,000 second mortgage on the home that we grew up in. And it was even the location of our church at the time as well. Super risky, but neat that he was willing to do that and to really bet on us. And so the beginning of our company, really we bought a couple of units in the state of Oregon, but almost immediately we moved out to Kansas City. And it was the math for us looking at rental income, real estate. The math was kind of a no-brainer. We could purchase for as low as 20 cents on the dollar, Kansas City compared to Oregon where we were at. Mm-hmm. And yet we could get as much as 80 cents on the dollar on rents. So in terms of cash flow equation, it wasn't even close. It was just kind of we did like a, napkin math, and we were like, this is a no-brainer. Let's move to Kansas City. And so that we did. We moved out in succession, each of us brothers. And we started out buying. We had no background. We had no financial backing, anything like that, beyond this initial investment from our father. We started buying single-family homes. We started buying, then we worked our way up to duplexes, fourplexes, and really grew it from there. 2009 was kind of the paradigm shift for us. We had about 150 units, about 40, 45 properties, somewhere in there. So the average unit size was right around 3-ish units. And we bought our first, we actually took some courses and were students of Dave Lindahl for a while. And that kind of gave us a little bit of the confidence to go out and buy some larger properties. So we bought our first 60-unit property middle of 2009, and that really was it for us. That was the paradigm shift. We knew from that moment forward that's all we were going to focus on. And so later that year, we bought a 96-unit, then a 107-unit, and that has really been the business model going forward, 100 units and above. And as I talk with more folks around the country, something I've kind of learned this. I didn't know how it was, how unique it is, but it appears that one of the unique things about us is just how laser focused we are. So we are really only one market and one asset class. And I think that laser focus, that comes from books such as Good to Great and others like that, the hedgehog concept, where we from a very early stage said we wanted to be the best in the world at something, and we wanted to be the best, and still to this day we want to be the best in the world at buying and managing apartments in Kansas City. And so that is still the model today, although we have just, I would say, tacked on pieces to that. So we've always done our own property management. We have our own construction. Starting in 2015, we got into development. So we've done probably 4 plus varying sizes depending on how you evaluate it. But we've done 4 or 5 development deals, so ground up developments that we've done. We're about 6 months in on a $60 million historic tax credit deal. So that's taking an existing property and completely, it's redoing the entire building. So it's the scope has kind of broadened a little bit, and the complexity, but at the end of the day, we're doing the same thing we've always done, which is multifamily in Kansas City.
Well, that's fantastic. I appreciate you providing that background for us.
Yeah.
I wanted to ask you, when you were doing the kind of back of the napkin analysis of market selection, what other potential markets were placed in consideration other than Kansas City?
Yeah, so we had a connection. It's a great question, and we had a connection to Kansas City. We did no other analysis of any other cities. We got very lucky. So since we've moved here, we feel better about Kansas City than we ever have. But there was not an in-depth analysis. It was so black and white between Oregon. I think if we were just bound to end up in the Midwest is really what it comes down to. We like the boring market. It's the best returns. You hear a lot of folks talk about this. The most boring average markets oftentimes are where you're going to see your greatest cash flows, assuming that it's not like a dying city. So I think we were just bound to end up in the Midwest is really what it comes down to. And we just happened to have a connection that lived in Kansas City. We came and visited. We're looking at deals, and that's how we ended up here.
Got it. So you make the comment of much better returns in the Midwest, specifically Kansas City. Does that comment or does that statement still hold true today? Now I know you guys are a completely different type of investor today than you might have been back when you first got started, right? The types of returns you're seeking, you're still seeking great returns, high returns for your investors and for your firm. However, I'm sure that you could probably be slightly more aggressive today on the types of investments you look at than you might have been back when you were first getting started. Is that a fair statement to make? Yeah,
and to that point, I would say this really we're getting into some good philosophical discussion. So again, this actually comes back to Intelligent Investor by Benjamin Graham. So really, it comes down to I just see this huge defining line between speculation versus value investing. And I would say absolutely it holds true and it's because we are value investors. So someone can be on can be in a really aggressive development deal. They can be on one of the coasts, and they can be speculating and high risk, high reward, creating some really great returns. We just have no interest in being in the business of speculating. This is the thing that we want to do until the day we die. We're deal junkies. We just love it. We love real estate. And so when I'm doing a deal, I'm have it in the back of my mind that the investors I'm working with and everything I'm doing, I want to be doing it 30 years from now. Mm-hmm. So I don't want to be betting on market timing. I don't want to be betting on, there's a lot of risk factors and that come into play when you start speculating. And so, yeah, it's really what it comes down to is philosophically, every deal we buy, we actually used to never put, and we didn't even look at IRR because IRR is, of course, projecting a sale, and inherently, I don't even like our IRRs.
I don't like it either.
Right. So we never even looked at IRR because we said, we just want to know, how is this going to perform for us if we never sell? Mm-hmm. It's a very kind of Warren Buffett type of mentality. Mm-hmm. We say, if we own this for 30, 40, 50 years, would we love this deal? And so that's the approach we take on every deal. So hence, kind of coming back to that is, in the Midwest, Kansas City, as a prime example, is where you're going to get your greatest value investing cash flow. And you can also, so we're actually in the process, we've sold some properties. We had a property, that literally just sold today. And it was a 45 or 43% IRR. And that's just the gravy. Mm-hmm. We never planned on that. The whole plan was, we want to own this long term. And if the market's so hot that people are willing to overpay or pay aggressively for one of our properties, sure, we'll liquidate but that's not, we're never backed into a corner where we need to do that. So it's really a philosophical question of, value investing. And I think value investing, if you're in real estate, if you're in, looking for cash flow, the Midwest is really, where you want to be at.
So let's dig a little deeper to that. Everyone's got a different definition of what value investing means. And so give me, Worcester's definition of truly what a value investment stands for.
Great question. So I would just, to put it in my own terms, the way I think of value investing is as opposed to speculating on what someone else would pay for an asset. It's me going in and I'm saying, I don't care what the broker's telling me. I don't care what this appraisal says. Mm-hmm. I'm going in and I'm saying, I think the value of this property is $17 million. If the rents are brought to the level that and then another factor that I would add in is a big part of value investing is all the things I can control.
Yeah.
I'm not speculating on interest rates. I'm speculating on, I know this market so well. I live here. This is 7 minutes from, my home. I know the rents should be $1,100 a unit and they're sitting at $850 average right now. That's mm-hmm. something that I know we can control. We can bring those rents up. So I look at a property and I say, that is worth $17 million. I don't care what anyone tells me, that's worth $17 million. And, this person's willing to let it go for, 13. And so it is that intrinsic value. Of course, a lot of people use that word, the intrinsic value of a property, with as little speculation as possible. And right now, this could be a rabbit trail we go on. But ironically, I'm seeing way more speculation on the quote value add, B and C product type mm-hmm. properties. People totally overvaluing them because everyone assumes that you can go in and do a value add and raise the rents, 10% or whatever. And so again, just because it's an older property, just because the word value add is in there, that doesn't mean you're not speculating. There can be a lot of mm-hmm. pretty aggressive and risky speculating even on that older product type. So really to come full circle, it's determining an intrinsic value that is based solely on things I can control, as opposed to hoping or speculating on things that are out of my control.
So being that there are a lot of speculators in the value add space now that might not know that market as well as you guys, that are, in your eyes, overpaying for these different assets.
Right.
How does one compete then? I mean, how do you guys still find opportunity when it seems, even in mobile home park space, I mean, we're seeing the same the same carryover as far as competition is concerned, and it's been drastic over the past year. Lots of private equity, lots of folks from out of state coming in and into markets they don't know at all whatsoever, and they're willing to. There's always someone willing to pay more than you or than I for any given property. At least in today's world, there's always at least one other person willing to pay more. At least that's the statement I stand by.
Yes.
I'd love to hear your perspective on it.
Yes. So I use this illustration. Most great deals come from two situations: someone making a bad decision, or there just being a situation that's very unique where a great deal is able to be had. Maybe the patriarch of a family passes away and the family isn't necessarily making a bad decision. They just need to liquidate that property right away for whatever reason. Mm-hmm. Those situations come and go at the same frequency regardless of where the market is at. People still make bad decisions in good markets, and people make bad decisions in bad markets. So the illustration or the example that I use is, it's the first person to the deal, and can you be, and that's why us having this laser focus on Kansas City is something that we see as such a great value. Is the layers of our tentacles are so deep in the Kansas City market that when there's a whisper of this property, the owner passed away, or this property is the occupancy just tanked. Anytime there's a problem, usually that's where there's going to be an opportunity. So our the contacts we have with brokers, with all the people in the industry. We were just having a team meeting earlier today, and it's that those whispers of potential opportunities, and you chase those down. And if you're the first one to a deal, we're closing on, it's a 410 unit deal right now, and we found out about it because we have a private lending division. So we do private loans throughout the Kansas City area, and someone approached our private lending division to get a hard money loan on an opportunity. This was one of those hearing whispers about what is this deal, and we looked into it and found out more about the deal, and it was highest and best use was to buy the whole thing, have it as an apartment community. So that's it's just an off-market deal. So the summary is the great deals are still there. It's really the secondary. You kind of have to just be more cautious on the deals that are fully marketed and the deals that are still getting a lot of that traction. You're just gonna be biting on less of them. But there's still, and then the last thing I would say is, what we're finding is the more complex a deal, the more likely that we're the ones to find it. So we recently purchased in December of last year is a $50 million acquisition, the tallest residential tower in the Midwest outside of Chicago. Really, really neat deal right here in downtown Kansas City. And it was just an incredibly complex deal. It's almost 100,000 square feet of commercial, 152 apartment units on the high rise. There's a parking garage involved. There's TIF income, and it was marketed really quickly. The long and the short of it is, it was a very complicated deal. And unless you're local and of real size, you basically weren't going to have a shot at this thing. So that just gives a few examples of the types of deals that are coming. If it's low-hanging fruit, standard 150 unit B asset that's just straightforward and it's fully marketed, almost impossible to find a great deal on those, because so many people understand it and are going to be comfortable bidding on it.
Got it. Good deal. I appreciate that insight. I want to talk about the vertical structure of your company. More common than not, folks that are, in your same exact shoes, ranging in size from 1,000 units to 10,000 plus. More often than not, you find that they outsource both their property management as well as the construction division of their company. Typically, they just use general contractors. They might have a project manager or project managers in-house. Mm-hmm. However, the actual construction team typically is an outside firm. However, you guys from the get-go, from the very beginning, have been fully vertically integrated. I know that it sounds like you might have tested the waters a few different times over the years, but ultimately have decided to keep it back in-house. Can you maybe speak to that decision to basically maintain everything inside your current environment?
Yeah, so I would say it originates from an obsession with returns. Mm-hmm. And performance for our investors. So anytime we've looked at third-party management, I'd say so. It starts with that wanting to have the highest returns possible, and then there's just a philosophical. The buck stops with us. If something's going wrong, we want to be able to say it's on us. The buck stops with us. It's on us. And when you have those third-party people, you can say, "Oh yeah, well, they're underperforming," and you can kind of push off that responsibility onto someone else. But really, what it comes down to is having that owner's mentality, being in the market. Mm-hmm. We just felt like we could do it better. We felt like this property is going to keep a higher occupancy. I'm sure you have the same experience with this. So much comes down to that on-site property manager. Mm-hmm. And if they have great accountability and someone great who's leading them and setting their goals and staying on top of it, a property can drop and rise really quickly. The performance can. And so just having that kind of on the pulse, and you have a level of control when they're your employees and it's your company. And knowing that we want to be in this market long term, we said, why not build a culture? Why not build a reputation as a company where we're going to attract the top talent, mm-hmm. where people are going to want, the best managers and the best people in the industry are going to want to come and work for us, because, the driver behind the numbers on a property are the people who are, working at that site or working on that site, whether they're corporate office or whether they're physically on the site. And so attracting good people was part of that philosophy. Mm-hmm. And so that's the property management side. Is we just always felt early on, we tested the waters a couple times, and it was really, there was a lot of just the initial expectations that were given. We said, how would you manage this? What would your fees be? How would you run this? And the expectations just right off the bat were pretty far off in terms of how we would expect a property to be ran versus how a third-party manager, what they would expect to be on payroll, what they would expect to be on, delinquency and occupancy, those types of things. So there were a lot of potential third-party management discussions that ended pretty quickly, just based on, philosophical differences on
sure.
Where do we expect this to perform.
I mean, at the end of the day, no one's going to manage your property, quite like you would. No one's going to care for it quite like you would. And at the end of the day, you and I both, we have a fiduciary responsibility to our investors to do our highest and best, right? To keep the finger in the pulse of that investment and to ensure that it's running at its peak. And the challenge that gets created, as you had mentioned, is, if something's going awry, it is pretty easy to say, well, the property management company's not performing, this, that, or the other. This is the challenges they've had. We're working on it. That doesn't feel good from an investor, from my perspective, being the actual general partner in a deal when I don't have control of that property management company. I'd rather have that same issue and have it be directly my fault. Then I can own it. I'd rather own it than actually have someone else responsible for owning it and me try to pass the buck to them. It's not a good feeling whatsoever.
Exactly.
Yeah. Well, fantastic. So I'd love to, you mentioned a 410 unit property that you guys are currently in contract in, just to, again, better understand the full picture of what value investing means to your group, your team. I know that you haven't closed on it yet, so you can't disclose probably a good bit of the information, but from a high level, 10,000 foot view, could you kind of run us through the case study? Just generally speaking, general price, what you're paying, what you think the opportunity is. Is it, below market rents? Are you going to be making a significant amount of capital improvements to the property?
Absolutely.
And all the above. Basically,
Yeah.
what is exciting and what's keeping you up at night about this deal because you're so excited to close on it?
Absolutely. So I always start with the story behind the deal. 9 times out of 10, there's a compelling reason why someone would be, why we would be getting a deal on an opportunity. Mm-hmm. And on this particular property, this is now the third iteration where we have, quote, purchased a property when it is either in the process of construction and purchased from a merchant builder. So someone who, by trade, that is their expertise. They're not an operator of property. Their whole skill set is in the building of it. Mm-hmm. And this is the third iteration where we've purchased either when it's still just bare ground, or in this case, some of the units had already been built. But basically, the value there is in all three of these situations. The value was completely off market. So we're negotiating one-on-one. There's no bidding process. And we're dealing with someone who can build very efficiently at a very low. So our purchase price is $1.08 a square foot. These are brand new apartments. They're duplex apartments, 1,200 square feet, 1-car garage in the arguably, I'd say, second best submarket in all of Kansas City, second best school district in all of Kansas City. Really, really ideal location, great submarket. And so we're buying at $1.08 a square foot. And because we negotiated, the builder was originally building them and managing them some himself, and then kind of had a not super targeted business model, but was doing a little bit of trying to sell them one-off. And again, this is a builder by trade. He's thinking, keep my team going. What's my, very, very focused on the building process, mm-hmm. And not experienced and not focused on what are my rents? How am I marketing this? Just not on the property management. Not a whole lot of focus there, and then not experienced from a selling standpoint as well. Wasn't really marketing it, and it was, the only way people would know about it is if they were interested in buying like one duplex. Mm-hmm. So it was being marketed as one off. Huh. So to summarize the financial value add is he was renting the units for $1,000. We negotiated to take over management basically almost 4 months before closing, and we currently manage the site now, even though we don't own it. We have an agreement worked out to where we manage it in advance of closing, and we're getting $1,350 a unit, between $1,350 and $1,505.
Wow.
And so that's, I actually just recorded we do a kind of a video tour of the site for our investors every time we do a new deal. And I was just out there recording this, and that's really the simplest summary. And to highlight the two ends of the spectrum on value add. One end of the spectrum on value add is you go in and you completely rehab the property physically, interior, exterior, common areas. You reposition the property, the reputation of it. You put in new management. You have kind of this whole lengthy, complex process, and at the very end of it, you have a plan and you hope to get a certain increased rent. Mm-hmm. That's about as complex of a value add process as you can get. On the other end of the spectrum, and where we've seen some of our best deals, is where we walk in and we say we could change absolutely nothing. All we need to do is just start charging the appropriate rents. That's the other end that's the most ideal end of the value add spectrum, where the property management, just maybe it's not a professional property management, maybe they're not marketing it very well. And that's really what you have in this situation is We are doing some upgrades. We're making them fully smart home apartments and doing some other things, modifying some color schemes and things like that. But for the most part, we're going in and we're simply charging appropriate rents.
Wow.
And that's the most exciting thing about
I wonder how he feels about that. just seeing what the opportunity really was.
Well, but
what it is today.
it's all about solving problems for buyers. You know, like he had his own problems and we solved a problem for him.
Yeah.
So he now has, that's the beauty of it, is I think most deals are win-wins. So he has now 410 units that he can build and sell. He has a much smaller profit margin, but he has that built in over the course of the next, it's a 18-month deal to finish out the build. So it's one of those where I oftentimes the best deals are win-wins on both sides, because he probably looks at that and he says, you know what, I couldn't have executed that business model. And to that point, I'll say one other thing. We actually, the best deal, I think historically, the best deal we've ever had, I don't remember what the returns were, hundreds and hundreds of % return. The person who bought it from us increased the rents like 200, did a minor repositioning, increased the rents like 2 or 250, and absolutely crushed it. We had ran the lifespan of that. We kind of we saw it as this was kind of the highest and best use, and he came in and he took it from a B- to like a B+, and had a home run of a deal himself. So there's oftentimes there's just a right buyer.
Yeah, I didn't mean that sounded a little derogatory. My comment was sounding a little derogatory, and I didn't mean it that way whatsoever. No, it's absolutely a win-win. I mean, at the end of the day, you mentioned that. I mean, his forte is building, its construction, it's keeping his team busy, and having ongoing work, right? And
exactly,
that is a huge one. So you came across the wrong way. Apologies.
Not at all.
But that's a huge home run. That's amazing. How much extra? I know that based on how he was building them, you guys have turned them into a smart home and a few other upgrades. Like cost per unit of upgrade, is that like another $5,000 to $8,000 per unit that you guys are kind of putting in that he wasn't?
Great question. $7,500.
Okay.
Yep.
Good deal.
Yep.
Good deal to
so
effectively justify another $400 or $500 a month in rent. I love it.
Yeah.
Yeah, that's fantastic. Now, I know you guys know your marketplace inside and out, right? And so this question might not be relevant. However, I'm going to ask it anyway. Are there any go-to resources, websites, reports that you guys utilize to help you understand, when you're doing, kind of back of the napkin underwriting on a property, sub-market vacancy, rent comps, rent per square foot, area demographics? Again, you guys probably know this like in the back of your mind already, like just being that you're laser focused. But do you utilize any outside resources other than just your knowledge, your own insider knowledge?
I would say that that's a great question, and that's one where it'd probably be good to have our head underwriter, Hoffman, here with me to answer that, because he's always tinkering and finding new little resources. So nothing that really comes off the top of my head. I would say us as partners, we're very focused on the high level. What markets do we want to be in? What are our strike prices? What are the returns our investors are looking for? Things like that. In terms of underwriting resources, really, the top thing that comes to mind is our Excel underwriting template. It's ballooned into 40 plus tabs, and it's just having great underwriting and understanding how to take a real life scenario, create an underwriting scenario that reflects that. I'm big on toggling. So I like to be able to say, toggle. I want to be able to toggle the occupancy. I want to be able to toggle the rents, and just sit with the underwriting and just play with it. And so that's of course unique to us, is our own underwriting template, and everyone's got their own. But that's, to me, 97% of a person's time should be spent just intimately understanding their own underwriting template and being able to add elements onto it based on the deals, that you're looking at. So that's the best, I think the best answer I can give you on that.
Now, you guys are structured as a fund, correct? So you have multiple different assets underneath one umbrella.
So that we're using kind of equal terminology here. So historically, the majority of what we've done are one-off syndications.
Okay.
Everything under our parent company in regards to everything that we're doing is Worcester Investments. But every deal is syndicated individually. Now, with that being said, 2 years ago, we did start an actual fund, a fund that invests alongside us. It has first right of refusal into any deal that we're doing. So it participates in the syndications that we do. Got it. And then it also invests in our private lending. So it's kind of like a balance between.
Okay. Yeah. The reason for that question was based on like an underwriting model. Like we do a fund structure that we do not do deal specific. So we underwrite on an individual basis, but then we also have it roll up into a fund model to see how it affects the fund performance itself. We've already got 6 properties in there. You know, what's it going to look like when this thing looks great as a standalone, but what does it look like and how does it affect those other 6 properties once they're lumped together?
Right. I call that, we do the same thing. It's our fund forecast. So I have all the assets in the fund forecasted out, and then we say, now let's run the scenario that this new deal comes in. Maybe it's a phenomenal 7-year deal, but the first 2 years are a complete turnaround and they're going to drag down the performance of their fund too much that we don't even want to do it for that reason, maybe.
Mm-hmm. Yeah, fantastic. So a couple other questions before we wrap this thing up for the day. You guys have a fairly large staff there, and I know prior to us starting the recording, we're talking about just building a legacy company that ultimately allows you to, you specialize in that certain marketplace. You want to be the best in that marketplace in the multifamily sector. However, one of the other objectives is to be able to attract the best talent, right? Mm-hmm. I'd love to speak to that a little bit. What are some of the, the contributing factors other than just, being successful investors? Do you feel that has allowed you to attract awesome talent, but not just attract it, retention is more important than attracting. Anyone can attract talent, but actually keeping them around so they're not interested in going off and going and doing themselves or going with another firm. How do you do that?
Yeah, that is such a great question. And I think this is one where if you talk with any business owner in any industry, they could talk for hours on this, because this is the area that everyone is, until the day they die, trying to improve on. We've got mentors that we work with, and they're in their 70s, and they're still saying, trying new things, and because at the end of the day, like you said, the talent you attract, that's one of the most foundational things to the performance of a company. It's the people, boots on the ground, and the people who are executing the vision that has such a great impact. So, with all that being said, I would consider ourselves novices in this area. I'm thirsty for we've tried a lot of different things. You mentioned kind of tools or things, resources for people. One that we use, which we have seen immense return and immense value from, is something called Culture Index. Mm-hmm. I would say out of all there's a lot of personality testing resources out there, Colby Index and other things like that. In our personal experience, the Culture Index is a 9 or a 10 compared to everything else, relatively being a 3 or 4 at best. It's just that much better. So that's one resource that we use, and it basically tells it predicts very accurately where a person is they're going to be strongest, where they're going to be weakest, how they process information, how they're motivated. So it's been a great resource for us. But, we've done Great Game of Business. We've done, so those are some resources. Philosophically, I would say that one of the obstacles for us is that we are a very fast growth company. We always have been. It's not uncommon that we'll, have to see, 30 to 60% growth in a year. And so someone who was right, I think this is my encouragement to people this is going to almost be the opposite answer that you're looking for. But one thing I do want to encourage people, if you are a business owner out there, is it's not necessarily a bad thing that if someone who was perfect for you when you were, growing from 10 units to 150 units, if that's the trajectory you're on, if they're not the right fit for you, growing from 150 units to 1,000, sometimes that just happens, and that's okay. So that would be one kind of reminder, is that there are phases that a company goes in, and sometimes people are a right fit for a certain phase. Now, to actually answer the question that you asked, I would say that culture and how for us, how we treat individuals has been the single greatest determiner. Being present, it's amazing how much impact it has when you take 7 minutes and you sit down with a team member. That actually has a great lasting impact. And so caring about the individuals on our team, and I would say from a business, from a financial perspective, having time and energy and resources dedicated to motivating, of course, finding and hiring, but motivating and taking care of team members. That's just it's a cost of doing business, and the ROI on those on that time and that money is you're always going to get a great ROI on that. And that's something that we've we started in our early 20s, so we've been at this for over a decade now. That's something just trial by fire that we've learned, is if you take your focus off of your team, whatever new time that you're spending by not spending on, you're never going to get as high an ROI as if you keep a really healthy focus on again keeping your team happy and encouraging and motivating and that kind of thing.
I love it. Do you guys have any profit sharing built into your model, or in addition to that, like any kind of ongoing education to where you support your staff to where if they want to go to a seminar or something else to really advance them, whether it be on property management, just even personal development? Do you have anything like that built in place? Yeah,
I would say that we've again, I would call us on that novices, and we've tried a lot, and we've seen we've had positive experiences with some of that. So to answer your question, we have a good incentive program on a site-by-site level, a profit sharing incentive level for the whole team. We've looked at and we've toyed with, we have not rolled it out completely on a corporate parent company level profit sharing. There's some complexities with taxes and a lot of implications that can get pretty heavy with that. So we've been looking at that for a while, and then in terms of ongoing personal development, that kind of thing, we have executed pretty well on that on a site level, but we're wanting to do more of that from the corporate office level. So again, I would say the ROI on that stuff is always going to be there. We're at the point now where we know it's important. Now it's a matter of determining which route is the most, beneficial, the best one for us as a company. So from a philosophical standpoint, always great to spend our time there.
Yeah.
But we're novices. We're thirsty. Check back in 10 years, and hopefully I can tell you, some new tricks and some new, resources that we've had success with.
Well, I think we're all continually learning, right? I mean, no matter how big of a business you are, like you had mentioned, like you're still working on the business and trying to move it along, help it progress forward. So we've been working to roll something out internally. We've played with different models, and ultimately,
what are you guys looking at rolling out?
Yeah, I mean, like a profit sharing model.
Yeah.
So we actually we have something that's very basic in nature, and it gets very complex once you actually dive into the intricacies of it. And so it can be a lot better than what it is, and it needs to be better. But we're not as large of an organization as you guys are, so we don't have as many different layers as you currently have, and so we're trying to keep it simple for today. But know that we need to continually improve. I mean, we love. Our staff is awesome. We want to retain them. We want to continue to attract, the same quality talent. And so you gotta continually improve. And we are very supportive of the ongoing education thing. I mean, if there's a personal development seminar, if there's something of that nature, I do a lot of that. And so if I think it's something that would be a great benefit to any of the staff members, we make it an option for them to go. They can join us, and if I feel like they're going to get a lot of value, whether even on a personal level or business level or both,
right.
We invite them to come with us. And we have the ability to do it. We're still small enough where it's not like inviting 100 people to Tony Robbins, which is $5,000 a head. We're not of that size, but however, we bring in, if I just read a good book, for example, the Go Giver book. I don't know if you've ever read it. It's phenomenal. I mean, I read it a couple of years ago, but we just bought it for the entire staff and also some of their family members, just because I think
that's awesome.
Such an impactful book. And it's a small book, but it has such a large impact. And I
really
think can help them in their own personal life as well. So,
one thing that just came up for me as you were sharing that is simplicity, I would say, is actually probably something I would encourage listeners to focus on when it comes to profit sharing, or if you have we have where we do a paid day of service to in the community, things like that. But people can only, you think of a team member. And for us, we have about 120 employees. When you ask them, hey, tell me about your company, people can only retain and remember and think on so much. So having a program and having it super simple, but harping on it and having a huge part of your culture, if someone can only afford to do one paid volunteer day a year or something like that, make it a celebration and a party, and everyone talks about it, and you gear up for it for a whole, for the month prior, and you take a ton of photos and video of it. Whatever it is, I think simplicity is actually a pretty valuable thing when it comes to building your culture. Someone says, tell me about your company. Oh, let me tell you about this day that we do once a year. It's so cool. Someone could talk about that for 2 minutes. That might be more impactful and more valuable than someone who has 17 programs, but no one can remember what they are.
Sure.
Why do we do that again? So simplicity, I think, is a pretty important thing there.
I love it, man. I love it. Well, Jesse, I want to be respectful of your time. However, I want to make sure we do not miss this end segment here. It's what I like to call the golden nugget segment of the show. And what I'd like to ask of you, and you've already shared a ton of golden nuggets already, and so hopefully you got one left in your pocket that you can dust off and share with us. But if you had one last golden nugget of advice or wisdom that you could leave with our listeners that may inspire and motivate them as they progress in their real estate investing career, what would that one last golden nugget be?
Oh, that's easy. I would say that the single most important and valuable thing, I think, in business is who you partner with and who you're working with. Whether it's someone, an extension of that is your team and your employees. So, of course, hiring a great team. The more immediate is who your business partners are, or who you are bringing in as a mentor if you have a board of directors. And so my golden nugget, and this is something that I spend as much time thinking about this as anything else, is who are the people I'm surrounding myself with. I am fortunate to have some pretty amazing brothers, and we're kind of iron sharpens iron. We all have our own strengths. So I got very lucky in having some great partners early on. But I come across a lot of people who are jumping around. They have a business for a couple of years with one partner, then that doesn't work out. They go with another partner. You talk with anyone who's been around long enough, and I'm trying to think of, there's a book, Effective Partnering. I'm gonna remember this as soon as we hop off. But having a focus on how to find great mentors and how to evaluate and find great partners. Again, it might be a joint venture partner. It's not someone that you're in bed with for life. It could just be a lot of great partnerships develop from. We did one deal together. We were completely separate businesses, separate LLCs, but then we did another, and then we were like, look, we just work great together. Let's just, call this thing what it is, and let's just join together as one. So again, that's pretty philosophical. It's not exactly like where the rubber meets the road, something you can act on necessarily that you're going to see immediate results right now today. But that's the foundation, I think, of all business is who you surround yourself with and who you partner with and who you work with. So
I think a big part of that is just being self-aware, like understand your strengths, understand your weaknesses, and
very well said.
Learn how to identify, the voids that exist in you. Learn how to identify those in other folks. Folks that have similar personality traits as you, that are a good cultural fit for for you, your business, what have you. But really, just be self-aware is more important than anything else.
Such a great point. Such a great point.
I think a lot of folks getting started, I mean, they're somewhat self-conscious to really voice where their weakness lies. However, there's a lot of strength in understanding where that is and moving past it. Don't ever try to fill that void yourself with being an expert at something that you just suck at, right? Like
totally
just put the focus where it's designed to be, how God built you, and just run with it and find someone else that fills that void.
Yeah, I spent so much time, literally like almost 9 years, trying to be one of my brothers. I respect him immensely, and he's such an amazing partner and brother and friend. And I finally realized, I'm just not him. Yeah. I have my own set of strengths. I have my own set of weaknesses, and my own personal development has just blossomed when I stopped trying to be something that I wasn't, and I embraced exactly who I was. And it just so happens that I now have an executive assistant who is 10 times better at all that stuff that I am not good at, and I was trying to do myself for so many years. So yeah, that's just a great golden nugget, I think, is that self-awareness piece. Yeah.
Jesse, this has been absolutely phenomenal. Really appreciate you coming here. Tell our listeners how they can learn more about you and your company. Where can they find you at?
Yeah, so our company is Worcester Investments, and it's like Worcestershire sauce. A lot of you know that, or Worcester, Massachusetts. So it's an interesting spelling, but if you just Google, Worcester Investments, all of our stuff will come up. In terms of connecting with me or with us, we are big on the adding value to others philosophy. So I have nothing to sell you or nothing that I really particularly want from you, but I would love to help you out in some way if that's a possibility. So that's something I get great joy from, is helping others, adding value to others. And, from a philosophical standpoint, I know it's going to come around at some point anyway, and so I don't really worry about that side of it. So happy to help folks. Hop on a phone call and add value to someone if I can.
Well, that's great. And just to ensure that you spell it correctly, because I butchered it for Jesse in the very beginning. Worcester is WORCESTER and investments.com. So
correct.
WORCESTER, and I'll put it in the show notes as well, guys. Well, Jesse, thank you very much for joining us here. It's been an absolute pleasure having you on the show, and I look forward to having you back on in the future day. You guys are making a ton of progress. You're in super growth mode, and it sounds like you've got a lot of exciting projects happening. These things aren't cookie cutter based on just even the quick explanation of the 410 unit and the high rise prior to that, which is I think you said the largest in the Midwest, or second largest, or
the tallest residential tower
outside of Chicago.
Yeah.
Yeah, that's fantastic. Well, again, thank you, Jesse, for coming on, and thank you to each and every one of you for tuning into this week's show. Until we meet again next week, this is your host, Kevin Bupp, wishing you huge success.